Hi there, and a very warm welcome to the first market update and market outlook for calendar year 2024. Wishing you a very happy new year. I hope you had a great Christmas, a relaxing break as we rounded out 2023, and you're all fired up for a great year ahead in calendar year 2024. For investors, 2023 was a welcome change after an extremely difficult and challenging 2022, and of course quite a challenging period before that with COVID, obviously rampant inflation, and the regional conflicts that we saw come to life throughout that period as well. Thankfully, the majority of that is behind us, and we saw a fairly positive year for most markets in 2023. The Magnificent Seven, as they have become affectionately known, the tech giants of the US market, Apple, Alphabet, Meta, etc., did a lot of the heavy lifting throughout calendar year 2023. We've seen rapid advancement in AI. It's hard to believe that ChatGPT has only been around for less than 18 months. It was released in late 2022. It is the fastest growing tech platform, solution, whatever you want to call it, that we have ever seen, and continues to grow rapidly. Now, it's important to recognize, I think, when we look at AI and the technology that sits behind it, that this is the worst version of AI that we will ever use. This is as basic as it's going to be, and the investment, the advancement in this space is going to be rampant over the years to come. We will continue to see more and more development in smart contracts, in digital currencies. We've obviously got a fairly important ruling in the United States coming up shortly when it comes to the crypto space. So we do expect that we're going to continue to see more and more development within this field going forward, which is obviously going to drive how investors should be shaping their portfolios and how companies will derive investor returns going forward. Looking at the economics, which has been an important one throughout 2023, we've seen relatively strong corporate earnings exceeding a lot of forecasts, particularly in the United States. We've seen inflation dropping rapidly, which has meant that central banks have been able to sort of cool their jets a little bit when it comes to the rampant rate increases that we saw over the last 18 months. In Australia, the US, basically most developed markets. So that is certainly welcome news for anyone with debt, anyone with bonds, anyone sitting on anything that is interest rate sensitive. We're not expecting that we're going to be going back to those sort of pre-COVID emergency interest rate levels, but we do expect that we will get a bit of reprieve, which obviously will be welcome news for mortgage holders, perhaps not such welcome news for savers who have been sort of enjoying a reasonable rate of return on their cash. But as I said, we don't expect that to go back to zero, so we do expect there'll be some reasonable returns there going forward. Outside of the United States, Europe and the UK, we do expect will remain fairly challenging markets going forward. A lot of Europe sort of teetering on that recession or recessionary levels. UK really still feeling the impact of Brexit, and we do expect that'll continue to flow through the numbers. So we're not looking at any major exposure in that region, but we do feel that there will be opportunities, particularly in the value end or quality end of those markets going forward. Outside of Europe and the UK, obviously Japan is really front and centre at the moment. There is talk we may actually get a rate increase in Japan, which would be a bit of a shock and quite counter-cyclical to the rest of the world, but welcome news to Japanese investors who have been sitting at basically next to zero inflation for years and years, as most will know. So certainly watch this space going forward. Outside of Japan, obviously a little closer to home in terms of economic impact, has been China. China's inflation has basically been zero, which was welcome news for anyone worried about inflation, but not so welcome news if you are a reliant trade partner of China. Now, of course, it's all eyes on the CCP in terms of what they do when it comes to economic stimulus. Watch this space. They're obviously very mindful of not having any sort of bubble impact or creating potential bubbles in housing, in their financial space, but it remains to be seen exactly what they do in terms of generating economic growth and more reliance on domestic demand rather than overseas markets in terms of driving China going forward. Looking at the Australian market, obviously quite a few important changes on the Aussie market going forward. We will in all likelihood get the 1 July rate cuts. So we will see basically anyone earning up to $200,000 will get a bit of a bonus from a tax saving there. Now, the other important factor there is also the fact that it potentially makes it a lot easier, a lot more palatable for Australian expats planning to go home and structure their retirement or their passive income. We now have a lot more money we can earn, pay a much lower tax rate. So it starts to throw up some different options when we look at generating a more tax efficient income stream back in Australia. So watch this space, crunch your numbers if you are looking at repatriating to Australia, because this will very likely have a meaningful impact on your plans. Now, we've also seen a record level migration into Australia over the last 12 months. We do expect this will continue. It's occurring at all levels: high skilled labour, low skilled labour, international students. Everyone is coming back into the country. That is having an incredible impact on vacancy rates across the country. Look at any home open, really anywhere in the country, obviously in the capital cities, and you will see exactly what I'm talking about. We've seen huge increases in rental prices, record low vacancy rates across the country, and we do expect this will continue. Now, what this also means is that those companies, those sectors that will benefit or profit from a rising population, so think healthcare, supermarkets, financials, in all likelihood will be key beneficiaries of this rising population figures going forward. So again, watch this space. No real update on the tax residency side, but we do expect we'll get something out throughout calendar year 2024. So again, watch this space. We will be providing an update as soon as we have more information on that one. Now, moving outside of equities and the sort of broader economic data in terms of what's happening, property and infrastructure, we do expect we'll do fairly well throughout 2024, probably more so on the real estate than the infrastructure side. Real estate tends to be more interest rate sensitive. So when we do get a pullback in interest rates, we do expect the real estate will actually do quite well over the next 12, 18, 24 months. So again, not the time to sell all of your stocks and go and put it all in property, but it is the time that if you don't already, to be starting to dip your toe in the water with some diversified real estate exposure, potentially if it aligns with your risk profile and your overall goals. Infrastructure, not so interest rate sensitive, more driven particularly by government incentives, obviously heading into a few elections throughout 2024. So again, watch this space. We may get a bit of an uplift depending on what happens there. The other real key focus for 2024 as we head into this rate decline potentially, or at the very least the end of the rate increase we've seen from central banks, is what happens in the bond markets. Over the last 2 to 3 years, we've seen the traditional relationship that bonds and equities have totally flipped on its head, which has meant that as equities have fallen, bonds have fallen as well, which is not the way that it should typically work. But what has led to that has been the rampant increase in interest rates, which has obviously meant that bond prices have moved inversely to where interest rates have head. Now, going forward, as we head into a rate decline, or again, that rate stabilization, we do expect that relationship will return to normal. So as equities rise, bonds will fall and vice versa, and bonds will go back to fulfilling their role of stabilizing portfolios going forward. What does that mean? Well, if you're a balanced or a growth investor with a mix of assets, we expect that those portfolios will likely do better going forward as bonds start to react to market stimulus in the way they traditionally should. So again, watch this space. We're very, I wouldn't say very bullish, but we are certainly watching closely government bonds, investment grade bonds, particularly short term, where we'll potentially get a bit of an uplift there, particularly as we do see potential interest rate cuts going forward. So a lot going on throughout calendar year 2024. We've got elections, we've got currencies moving all over. The Aussie dollar, even though we're not quite at that peak 114, 115 level, still pretty attractive at 111, 112 to the Sing dollar. We've got rental prices in Singapore finally stabilizing. Welcome news for anyone moving to Singapore or renewing their lease agreement throughout calendar year 2024. And of course, hopefully a bit of a decline, or at the very least, no more letters from our banks informing us that our interest rates are going up on our mortgage. So plenty going on. We expect it will be a news-heavy year, but a positive one for investors, particularly investors focused on the quality end of the market where valuations remain relatively attractive. Really appreciate you tuning in. Do reach out with any questions you've got. I look forward to connecting with you and catching up with you throughout calendar year 2024. But thank you again for your time and tuning in. I look forward to speaking with you soon, and all the very best for the year ahead.